Hi everyone, welcome to Film Bright channel. Today we'll be talking about things to consider before you get a credit card, a mortgage or a loan. The first thing to consider is your credit score. Your credit score is what shows that you are responsible to the lender. So with your credit score, the lender is able to decide how much they are going to loan you and at what interest rate they would give it to you. The credit score is simply a 3-digit number that determines how responsible you are. So it's usually between 300 to 850, but then it depends on the company or whichever provider you are using. So it's always advisable to have like at least 700 and above as your credit score. Now the interest rates that you will get, it's dependent on your credit score and some other factors too. So when you are looking out for the interest rate, you are checking the APR. APR means annual percentage rate, which is basically the price that you are going to pay for the loan you are collecting. APR would mean your interest rate, including the hidden charges or any fees at all that may be attached to the loan. So the big question usually is, do you need a credit card to build your credit score? Because some people would say they do not want to get a credit card for any reason, and then they are so interested to know if they would also build their credit score even if they do not have a credit card. And the simple answer to this is yes, you can, and I'll tell you how. So you can build your credit score even if you do not have a credit card if you have a student loan, or you have a mortgage, or you have a personal loan, anything at all that you are paying for, and then it gives them an idea. You have an online presence that, oh, you owe this money and you are responsible enough to keep paying back. However, if you're asking whether you can build your credit score with just your debit card, the answer is no. Now this is because your credit card does not affect your credit score. This is because you are using your own money. You have not borrowed any money that you are paying back. So you are spending your own money only. So they are not able to monitor how responsible you are with money. So the next thing you have to consider before you borrow money is the interest rate. The interest rate is the price you pay for borrowing money. Before you decide to borrow any money, you should first of all consider at what interest rate are they going to give it to you. Now the interest rate a lender decides to give to you is dependent on your credit score, the job you are doing at the moment, your debt to income ratio, and probably your other responsibilities. So by this I mean, if you have a good credit score, your interest rate is probably going to be lower than someone who has a low credit score. If you are doing a permanent job, it gives you an edge, so you are more likely to get a better interest rate than someone who is in a temporary job or part-time or maybe a contract job, so they are not sure of your job in the long run. Anyway, depending on the loan term. Your debt also determines how much they are going to give you and at what interest rate sometimes, because if you already have lots of debts accumulated for you to pay, then it's going to reduce the amounts that they are going to give you. Also, your responsibilities too would also determine how much they are going to give you. So if you have like a family that you are catering for, and then it's weighing you down, it's weighing your income down, they may consider giving you a lesser amount just because they feel you may not be able to keep up with the payments. On the other video, I already mentioned what good interest rate is and exactly what you should be looking out for, like what percentage you should be looking out for. Let's say you are going to get a mortgage or credit card and whatever. I think I've explained all of those things. Otherwise, I may mention it later in the video. So yeah, check out the APR and make sure that it's within what you can afford, because it can put you in a trap. Okay, so the next thing you have to consider is fees and hidden charges, because sometimes you find that most loans will have their own fees and other hidden charges. It is your right to know exactly the fees or the hidden charges attached to that loan, so make sure you ask your lender. Now the purpose of this video is to make you aware of all of this so that you are informed, and then you ask the right questions when you are meeting these people. Because if you do not know, you may not even ask, and then you may be taken unawares in the future, and then you don't even know what you are getting yourself into. So it's very important to know exactly what you are getting yourself into, to know the right questions to ask. Because if you ask, definitely they will tell you, but if you don't ask, they may not tell you. Not that they may not tell you, but I mean, they will give you all the papers, but then anyway, that's the next thing. Make sure you read in between lines, okay? Read the fine prints just to be sure that you know exactly what you are getting yourself into. Sometimes you may find that when they're giving you a loan, that there may be a one-time charge, which is normal, but you should know. Sometimes there could be something they call prepayment penalty, which means if in the future you decide to pay off whatever it is you are owing them just before the loan term finishes, then it means that they are going to charge you a certain amount of money before you are able to opt out of that loan. So you should have an idea of all of this, because you never know. Who knows, tomorrow you may be lucky enough that you have the money and you want to pay it off. At least you have to have an idea of the penalty that is attached to this loan, and then you make an informed decision, okay? Another important thing that you should consider is the monthly payments. I find that a lot of people do not consider this when they want to borrow money or go into mortgage especially. But this is very important, because if you do not consider this, you will find that you may be struggling to pay back whatever you owe at the end of each month. I'm going to specify the mortgage one because I find that a lot of people are so interested in getting the bulk money, which is the deposit, and then they feel that they are ready to go into getting a mortgage, but then they are not sure if they are able to afford the monthly payment. So this is something you should be aware of, okay? Make sure you do your calculations right. I would advise you use the 2836 rule. Now the 2836 rule is just advising or stating that your rent or mortgage should not be more than 28% of your income. I think I mentioned something like this in my previous video, so you can go have a look. And then the 36 is also telling you that your total debt in a month should not be more than 36% of your salary or your income in a month. So let's say you are getting that mortgage, and then you know you have any other debt that you have accrued, like you are still owing, maybe you are into a student loan or credit card debt or any other loan at all, or even car loan if you did a car finance. Then you will have to calculate all of these debts together with the mortgage, and then make sure that it is not above 36% of your income. Because if it is, then you will be struggling. Remember, this is not the only responsibility you have. You could have so many other responsibilities, you know. So please try as much as possible to put this into consideration when you are going for a mortgage, a loan, or even a credit card. The next thing you should consider is the loan term. Loan term means the number of years it's going to take you to pay off whatever money you have borrowed and the interest accrued. So there is a short-term loan, which means you are paying back this money in a short period of time. It could be over 3 to 5 years. With short-term loans, you find that you can be paying much more monthly, but then the interest rate is usually less. For the long-term loan, you are paying for a longer period of time. The monthly payment is usually less. However, the interest accrued over this number of years is usually much higher. For instance, let's assume that you have borrowed £300,000 to get your mortgage, and then you are going to pay it over 30 years. Yes, so let's say you are going to pay off this whatever money you have borrowed and the interest accrued over 30 years. Of course, what you will be paying back monthly will be much less than if you had borrowed the same amount of money and you are going to pay back in 15 years. You will be paying much more, maybe almost double of what you are going to be paying if you had it for 30 years. Now, the good thing about the short-term one is that you are going to pay less interest in total, you know, but for the long-term loan, you are paying much less per month, but then in the long run, you will find that you are paying very much higher interest. So the difference is quite huge. Okay, another thing you will have to consider is fixed rate versus variable rate. So fixed rate means you are paying an interest rate that is fixed, which means it's not going to change over that number of years that you have agreed with the lender. So let's assume that you take a mortgage or any loan at all, and then they give you a fixed interest rate, which means you are going to pay a particular percentage for that number of years. For instance, let's say for the next 5 years, you are going to be paying 4% or 5% as a fixed rate. So no matter what happens, you are going to be paying this particular percentage as your interest. It does not change. Now, the good thing about this kind of interest rate is that it gives you stability, in that it's not going up and down, so you are stable. You know exactly the amount that is going out of your pocket every month. But for the variable one, you find that it could change. It could go up or down, so it depends on the Bank of England rates. Let's assume the Bank of England reduces the interest rate. It means that you are gaining, so which means whatever interest rate you are paying will come down. However, if they increase the interest rate, it means that you will be paying higher. So for me, I would always advise you go for the fixed one if you really like stability, because it really helps you to be at peace. So the next thing you are to consider is the credit limit or the loan amounts that the lender is able to give you. So higher limits are always given to people with credit score, but if you have a poor score, then there's a high probability that they are going to give you a lower credit limit. So the loan amount also is how much the lender is willing to give you based on your income and your circumstances, like your credit score and your debt level. So if you are already owing some money elsewhere, it will bring down the amount that they are going to give you. So my advice is this: if you want to get a mortgage, then I will advise you try as much as possible not to go into any other loan. Okay, so if you have a need to get a mortgage and a car, please always go for the mortgage first before you consider the car, because if you go for the car first, then it means that it's going to lower the amount they are going to give you as a loan, because now you already have debt that you are accumulating. So it's best for you to go for your mortgage first, and then you can go for the car loan. Another thing you have to consider is exactly what you want to do with the loan. Are you getting this loan for your business, or for your daily expenses, or is it for buying a house? So if you know exactly why you want this money, it will help you to know exactly what type of loan you are going for. So if you need money for your daily expenses, you will go for your credit card. If you need money for business, then you can go for personal loan. If you need money to buy a house, then you can go for your mortgage. So however, I keep advising that you shouldn't take any personal loan if it is not very, very necessary. Yes, I say this because personal loans are usually quite expensive in terms of the interest rate. So always check the pros and cons before you dive into that. Okay, now the last but not the least is the lender's reputation. Yes, always look out for the lender's reputation online, and check their customer reviews. You can check the BBB, it's called Better Business Bureau in the UK. So their online presence is there. You can go have a look and see exactly what the lender's reputation is like, because people will be complaining on there if they are having issues with them. To summarize, before you apply for any credit card or loan or mortgage, first build your credit score or check your credit score. Aim for good rates. Okay, make sure that you are scoring at least above 670, if possible above 700. Okay, check your interest rate, compare the interest rate. Don't just focus on one lender, compare different lenders and check their APR. It matters a lot. Another thing is to read the fine print. Make sure that you read everything. Please take your time and read, just so that you don't regret any of the actions. Calculate your monthly payment, just so you don't overburden yourself in the future. And then you check the lender's reputation. If you do all of this, then you are good to go. Okay, you will be making an informed decision, and you will be happy that you did, because now you are in control. Okay, you are able to ask the right questions. And I hope this gives you the confidence to walk into any financial advisor's office or any lender and then ask the right questions, make the right decision, and you will be happy with yourself. I'll see you next time. Please do well to like, subscribe, share, and comment. Thank you very much for staying this long. Bye.